John Greenwood is a former advisor to the Hong Kong government and council member of the stock exchange there. These days, he's chief international economist at Invesco Asset Management. Joins me in the studio now. Thanks very much indeed for coming in, John. So, I mean, just looking at China's trade surplus data there, how difficult do you think it's going to be to sustain those sort of numbers in an increasingly difficult macroeconomic environment?
Well, I would expect them to slow a little bit, but not drastically. The really important point, I think, about China's trade is that China's exports are growing substantially faster than the growth of the exports of any other country in Asia, and the trade surplus is widening a lot more. So China is clearly gaining ground. That could be simply due to reallocation of labor and its own competitiveness, but it could also be an aspect of the undervaluation of the currency.
All right, so there are significant risks to that going forward?
Well, no. What it means is that China's trade surplus is likely to continue very strong, and China will make ground against other Asian currencies as long as they've been appreciating their currencies more rapidly than China. China's been keeping its currency down. Of course, it's appreciated, but only relative to the US dollar.
All right, and that will offset the impact of weakening demand in the developed world for Chinese goods?
I think only to a degree. I would expect China's trade growth to slow to the high teens, but not down into single-digit growth.
What about domestic growth in China?
Still very vigorous.
Yeah.
It's true that the Chinese have been attempting to slow domestic demand, but they've been doing that mainly through quantitative measures, attempting to impose credit controls, and using reserve requirements. What they haven't really done is to raise interest rates sufficiently to limit the amount of credit. And what we're seeing is the emergence of credit or leakage of credit outside the official banking system into markets where people can get genuinely good market interest rates. In the official sector, interest rates are restricted, and therefore you tend to get this leakage and growth of credit outside the system. So the official numbers no longer tell you what the total rate of growth of credit is. And that means that China may have to continue on its squeeze program for longer.
Well, we had inflation data from China as well, didn't we? Rising at the fastest pace in 3 years. So, as you say, they do need to hike interest rates more significantly because right now it seems to be too slow, and then even combined with the reserve requirements on the banks, it doesn't seem to be doing the job.
That's right. But I think a key point is that China's method of squeezing is only going to have an effect after a 2-year period.
All right.
So it takes about 2 years for that effect to come through. So the inflation rate we're seeing today is the result of the very rapid money and credit growth that we saw 2 years ago. What they do now will affect inflation over the next couple of years. And at the moment, I would say that they're not really squeezing hard enough to bring it down significantly. So I would expect Chinese inflation to peak out moment, roughly now or over the next few months, but not to come down significantly. And so that's where they will fail. They will fail to get the inflation rate back down to sort of 2 or 3%. I think it will stay in the sort of 4 to 6% range unless they tighten more.
And of course, the US Federal Reserve watching inflation in their country very closely. And that announcement about keeping rates at ultra-low levels and also the possibility of more QE, what did you take away from that? I mean, markets were watching and waiting to see what the Fed would deliver, and I suppose their action was cautious, not robust. Do you think there is worry, if not panic, behind the scenes about the direction the economy and the markets are taking right now?
Well, the fundamental problem is this. The US is like an athlete who's broken his leg, but his coach is saying, here's some stimulus, here's some glucose, take the glucose. He can't run just with the glucose stimulus. The broken leg corresponds to the broken balance sheets. Balance sheets are in need of repair, and it takes a long time. just like it takes a long time to repair a broken leg. The financial sector, banks and non-bank financials, as well as households, have had heavily over-leveraged balance sheets. And it's going to take many years to repair that, as we saw in Japan.
Just a quick final question, John, if I may. Do you think there is a willingness at all, an acknowledgement on the part of policymakers to accept that? Because right now they're opening the door to possibly more QE.
No, I don't think policymakers are patient enough. They want a quick stimulus and a quick result. They want that unemployment rate to come down. On the one hand, they want to stimulate the economy, but they also want the inflation rate to come down. So we're going to see, I think, another episode of QE, but I expect it later in the year or possibly even next year.
Okay, well, really good to get your analysis. Thank you so much for coming in. John Greenwood, Chief International Economist, Invesco Asset Management.